And welcome everybody to the Selfwealth Live Technical Analysis Edition here with me, Roger, and Jason McIntosh on the other side of the screen right here. Jason, how are you today?
Okay, Roger, I am well. Looking forward to talking all things trend following today. It's one of my favourite topics, so I think it should be an interesting show.
Yeah, and I think it's going to put together a lot of the things we've talked about over the last 10 weeks, right? So, and it's an important topic right now. If you've noticed, I thought I'd wear a theme top at the moment. I'm a little bit bearish on the markets at the moment. So I'm generally a very bullish guy in life, I think, in most cases. But I'm wearing red today because I feel a bit bearish on these markets at the moment. And I think I've been watching a few of your videos as well, but obviously knowing how to read the charts, right? All the markets around the world are certainly showing a bearish trend at the moment. So I'm wearing red for that matter, just to let everyone know that's
I'm
my
sticking
feeling.
in blue. I'm being the optimist of the two of us, and so
Okay.
you got to have the bull and the bear.
You got to have the bulls and the bears in the markets as always. Otherwise, we wouldn't have a market, right? So yeah. All right, Jace, did you want to quickly go through the disclaimer?
Yeah, so always important to remember that everything we talk about today is general advice. So just quickly pop up the disclaimer. So it's, look, everything's general in nature. Nothing is tailored to your personal situation. If you need any clarification, well, then you've got to go and get your own personal advice because, as I say, this is all general. And the other important point is I'm not part of Selfwealth. I'm from Motion Trader, and Roger and I come together and we do these videos together on the Selfwealth YouTube site, but I'm Motion Trader. So just something to remember there as well.
Yeah, and thanks for that, Jason. I think I might just also mention a shout out to Rob, who's our amazing marketing guy. I'll just say marketing guy. He's obviously got an official title here at Selfwealth, but he's doing an amazing job with running these live sessions over the last couple of years. He's been doing that with Owen Rask on a Wednesday night at 6 p.m. And that's where they talk more about the sort of fundamental analysis and the bigger picture, but the picture around share trading on a fundamental level. Whereas we decided to do this about 10, 12 weeks ago now, talking more about technical analysis, reading the charts, which is just another element of trading, right? So Rob is that man behind the keyboard there, and he's doing a lot of the helping us set up this from a technical point of view, and doing an amazing job as well. So thank you, Rob. And guys, if obviously don't forget to like and comment and subscribe to the channel as well. Do us a huge favor there, and you can do that to Jason's Motion Trader channel as well. All right. So of course, today we're going to be talking about trend following and confirming why it can work. It works, right? Because we're in a condition at the moment where it's tough. It's quite tough. We were just discussing this before with Jason before we got online, right? So I'm looking forward to get into this and just confirming everything here, Jason. And we're going to turn this top into green very soon, I hope, even if it takes a couple of years, right? So, yeah, Jason, can you let us know what is trend following then? Let's
Trend following. Well, look, I would describe trend following as the Indiana Jones of investment strategies. And you might think, look, what does Indiana Jones have to do with investment strategies? And you think, what does Indy do? So what he does, he goes to these faraway places most people have never heard of, and he goes looking for treasure. And that's kind of what we use trend following for. It's about it doesn't matter what market you're talking about. It could be equities, it could be currencies, commodities, bonds, you name it. If there's momentum in the market, you can use a trend following strategy. So it can pretty much take you anywhere. You don't need to be an expert on the underlying markets. All you've got to be able to really do is to be able to identify the price action, understand, is it a bullish phase, a bearish phase, a sideways phase, and then use some of the rules which we'll talk about today to then manage that trend. So trend following is fantastic because it can take you anywhere. You can look at all sorts of interesting markets, and it can throw up a whole lot of opportunities. And I think to bring it back to its simplest form, it's really about buying stocks that are rising and avoiding stocks which are going sideways or which are falling, and using these trend following strategies to to do that. We're really separating the market into different camps. We've got the where we've got momentum. That's where we want to look. We want to look for our opportunities where the momentum is to the top side. Where it's sideways or down, we just step away. So we can really hone in on the interesting areas of the market and leave a whole lot off to the side for another time.
Yeah, and it's interesting you say that. G'day Hassan, thanks for saying hello. It's good, and it's interesting you say that because it's sort of contradictory, because obviously Rob behind the keyboard here said buy low and sell high, right? And this is such a common thing in our industry where everyone wants to buy low, right? But then, yes, that could work. Everything works, right, in one sense, and everything doesn't work in another sense, right? So, you always, whenever you buy low, you could you never know. You're not riding that trend, really, are you? You just, it's the opposite to what we're talking about, isn't it, Jason?
Yeah. There's a lot of cliches which I think people misinterpret, like buy low and sell higher. It's buy low, sell high. I think a lot of people interpret buy low to buy as prices are falling, which is something we'll talk about as we move through today. That can be quite a dangerous strategy. Really, trend following is all about buying high and selling higher. So it's about buying with the momentum of the share price or the index or whatever it is that you're looking at. Never go broke taking a profit. We could go through all these cliches of where, when you actually examine them and test them, that they can actually be a disaster. Never go broke taking a profit. Well, you can go broke very quickly if you're taking small profits and large losses. So you've got to be careful with some of these popular maxims that go around the market, because a lot of them are really nonsense if they're interpreted the wrong way.
Yeah, definitely got to find, anyway, if you're going to do that, you've definitely got to find the right stock to buy low, right? So, or continue buying low on the way down. All right. So, talking about trend following, back on the trend following, how has it helped you shape you as a trader that you are today, Jason? Why did you choose this? Why did you choose trend following?
I think trend following for me, it really opened my thinking to the concept that a market can move a lot further than almost anyone believes possible at an earlier period, and that a lot of money can be made by staying with a stock or a market, for that matter, that is moving, and not having preconceived ideas of how far it should move or can move, or where a point where, look, it surely can't go any further. Because a lot of the time, some of these markets can move a very long way, more than anyone would anticipate or think possible. And that's where a lot of money can be made when you start to follow trends. So letting profits run is a key part of a trend following strategy. And I think a mistake a lot of people make is that they do sort of put upper expectations on where a stock can run to, and they'll worry as the stock is moving higher. They'll worry that, look, should I get out now, because surely it's gone far enough, and I don't want to give my profit back, so I'll sell. And I'll show you an example. I think it's good to actually get a chart up on the screen. We'll actually work through this a little bit. So I've got a chart up here of a stock called Calix Limited. Now this was a classic trend following stock, and this is a great example of where the big money can be made by staying with a trend. And it's really a case of when something's working, I think it's a case of hoping that trend will extend higher and holding, rather than worrying it's going to end and sell. So I think that's quite an important concept to take on board there. Hope something will keep going rather than worry that it's going to stop going, because then it opens up the potential for you to stay with that momentum and maybe make it, or maybe get a really good result from it. So Calix is an interesting one. It turned up in the Motion Trader Signals, and it's a stock I actually had in my own portfolio. It turned up in the signals in September 2020. You can see like these are some of the concepts we've spoken about in past weeks. Moving averages. The moving average started to turn to the upside. So the 50-day was above the 100 days. We had rising moving averages. We had the price above the moving averages. And then one of the key entry rules I use is a stock hitting a 70-day high, which it did at around 90 cents. So this is where I got into the stock, somewhere around here. Members of the Motion Trader Service, they had the option of getting in. And then another interesting thing as well is when a stock triggers an entry signal, it doesn't mean that it's going to double next week. Look how Calix initially performed. It rallied for a few days and then pulled back over a couple of months, pulled back towards the moving averages.
Sorry, Jason. So can I just? We were looking at. Now I've just realised we were looking at a log performance log chart and not the actual trading view. So that's it.
Goodness me!
Because I realised just okay. Now we go. Now it's the one.
Why did you mention that, Roger? That is the chart we need.
I was listening.
We're going to talk about later on. Yeah, so this is the share price of Calix here. So yeah, you can see those moving averages cross, and share price above the averages. Share price pulls back. This is something we spoke about last week. Markets often pull back towards the averages. It's not as if something gets above those moving averages and just keeps marching higher. Pull back, then it starts to move upwards, and you can see this stock moves a long way over about an 18-month period. I ended up getting out at around $5.70 or something. Got in around 90 cents, out at about $5.70 when it hit the trailing stop. And it's the thing with like understanding trends and why I've moved towards this type of trading is because this sort of move becomes possible when you understand the power of a trend. So this is a trend and it is completely tradable. It's completely accessible to anyone who wants to let a profit run and wants to give their stocks some room to move around. And look, some people say, look, why didn't you get out at the top? You know, I got back out down here at $5.60, but the stock topped out here at $9.40, or maybe this previous peak at $8.20. There were better selling points. But the point I make to people who think, well, look, you gave back too much at the end. The point is, well, you know, nobody knew this was the top. Nobody knew we had another good high at $8.30. It's like saying, well, you know, why not sell after the shares has doubled? Because maybe that's the top, or maybe the top's a couple of months later, or maybe the top's a few months after that. Point is, we don't know where the top's going to be. So when we follow a trend, it's about letting the market run until a point where it peaks and then starts to pull back and triggers a trailing stop, which was talked about in previous weeks. It's not about trying to pick the high point. And one of the areas I've had some really good success in the last 10 years or so has been in the small to mid cap space, because you see the thing with momentum and then staying with trends, like looking for trends through momentum, it's like momentum scans is a bit like momentum's a bit like opportunities calling card, in that if you got a process where you can identify potential trends, you can find some of these stocks that few people are talking about. Like almost nobody was talking about Calix back here in 2020. Most people hadn't heard of it. I'll show you another example. This is a stock called DugTech. So most people probably haven't heard of Doug Technology. That is going back. Let's go back to the present day. Here it is here. So this is an interesting stock. What this does, it provides software and computing solutions to the oil and gas, mining and engineering sectors, and they produce this specialized analytical software. So it's a sort of company that, unless you're really looking in that space, you're not going to find. But this turned up in the my momentum scans earlier this year. So you can see here, this is back in January. You can see those moving averages crossing, and this is where it turned up in the Motion Trader signals. And that's the one which I actually bought myself. And so we've got those moving averages cross. we get the breakout to a 70-day high, and then it's a case of letting that trend run. Now, and this is interesting to think about as well, because you look at this, people will look at this and you see this big sweeping uptrend and go, well, look, that was all, once you were on board, it was all pretty easy. But it's actually not, because look at these pullbacks along the way. These are like near close to 20% pullbacks, and there's several of them. So when you want to, if you say, look, I like this idea of running with trends, you've also got to get your head around how you're going to stay on the trend and when you're going to be able to identify your exit point. Because to get these good trends, you've got to be able to see off these moderate pullbacks along the way. And it's a key part of making the whole process work. And this has now got a market cap of about $216 million. So yeah, it's a sizable company, but it's only just inside the All Ordinaries, which is a top 500. When it first triggered, it was about 100 mil market cap. So it's kind of doubled in the last 9-10 months thereabout. And look, as we were saying earlier, it's like people talk about buy low, sell high, but trend following, it's really about buying higher and selling higher. So it wasn't about trying to buy Doug Tech when it was falling, trying to buy it, where's the lowest point? Try and buy the lowest. It's about trying to buy the low. Didn't get in at the low down at in October 2020. It was waiting for the market to get back above rising moving averages. So it's buying high in that sense. Buying at a 70-day high. It's buying high and then hopefully selling quite a bit higher. And lots of research that supports the idea that markets move in these trends, and these trends can produce that exploitable edge. And I'll actually show you the anyone who's interested in like learning a bit more about trend following. Just show you. Just jump back to me. This is a great book. It's a book called Trend Following. A guy called Michael Covell. I think you should be able to see it all there. This is something I bought years ago, and it really sort of like helps to all these great interviews with high-profile trend followers, people with trend following big funds, and talks about their start, talks about all the evidence behind how markets move in these trends. So one of those fascinating books to have a look at for those who want to delve even deeper than we can go in the short space we have today.
Yeah, look, once again, I don't think there's any shortage of books on technical analysis and trend following. I think that's a great example of it, of one, Jason. I haven't read it, but at the end of the day, I think there's so many out there, right? And I think you also bring up a good point about finding those companies that you would not have seen. Like, imagine if you were someone who's just doing the average everyday kind of investing and trading, and all you're relying is on someone's calls or someone's fundamental analysis. And are they analyzing 2,000 stocks in the market? How could a team or small team possibly analyze 2,000 stocks? When you have software out there that can do it all for you within moments, and all of a sudden you identify companies that you actually might be interested in. Even if you're not a trend follower or a technical analyst, you might actually be interested in this company. It sounds like a very interesting concept, to be able to invest in a company that provides software to engineering, but that you would never have picked that. Most experts at the moment are always just saying, hey, invest in ETFs, invest in ETFs, invest in ETFs. But, having the process that you're showing us now allows us to identify so many more companies on our great ASX market that we have, right? So it's great. It's great.
Well, even look at the performance of Doug Technology over the last 12 months, and it's very different to what the ASX 200 has been doing.
Yeah.
Momentum can help you put the spotlight on areas of interest. Now, a lot of stocks which show momentum will then not have follow-through momentum, and they'll reverse course and they'll come back and you'll get a loss. But we have exit strategies to help minimize those losses. But it's when we can identify stocks through momentum that maybe we wouldn't have otherwise known about. You can see where there's a potential interesting story there, if you like, to look into the fundamentals, and then using the momentum to find them, and then using the trend following to stay on the trend if that trend continues to unroll. For as long as it unrolls, something might run for a couple of months or a couple of years. You only know in hindsight. but having that willingness to give it some room to move, the willingness to risk giving back a moderate profit to get a large profit, that's where trend following can really lead to some pretty sizable gains, as we saw with Alex.
Yeah, exactly. Since we're talking about books, if you've got any of your favorite books, make sure you put it in the comments there. I'm curious to know what everyone's read out there and what educations they've used, because there's plenty of them out there, as I said. And if you have any stocks that you want us to have a look at quickly at the end, then pop them in the comments as well. Just remembering we don't provide any personal advice, just general guidance only, as obviously. So, Jason, what are the most important rules you would advise to follow as a trend follower?
Yeah, so trend following is really built around five core principles, or five key rules, and these are pretty much the bedrock of how trend following works. And it's not just a case of buy something and then hold and see if it goes up. It only really works when you pull these five rules together. So the first rule is spreading risk, and it's which is quite different to what I think a lot of people do. I think a lot of people, there's research which shows a lot of people, there'll be like 1, 2, or 3 stock portfolios. So say a 2-stock portfolio or a 3-stock portfolio, there's a high concentration of risk, and you only need one thing to go wrong with one of those companies, and a big portion of your portfolio can be severely impacted overnight. So spreading risk, it's all about, so the classic trend following approach is about many relatively small trades. So what you do when you do that is that you're kind of siloing the risk in many different silos. So if there's an issue in one area, it's contained. So if one stock comes out, if you've got say it's a 20-stock portfolio or a 40-stock portfolio, if one of those 20 or 40 stocks went to zero overnight, it's affecting 1/20th of your portfolio. It's an annoying loss, but it's still relatively small. Whereas someone who's got the 2-stock portfolio, well, half the portfolio has just gone to dust. So spread that risk. And also when you spread risk, you're also increasing the possibility or the probability of getting on a stock like Calix or Doug Technology. Because we never know. We can never be sure, no matter how good you are at fundamental analysis or technical analysis, we never know which stocks are going to deliver the really big results. It's just not that simple. Nobody can really pinpoint the biggest winners, except when we look back in hindsight. And so by spreading your risk across multiple possibilities, which are showing favorable characteristics, you're increasing the odds that you get on several of the ones which really do get into substantial trends. And that's where a lot of the money is made. So that's rule number 1, spread risk. The next one is all about investing with the trend. And that's what we're talking about with Calix and with Doug Technologies, investing with the trend. We want to invest when prices are rising. So just going back to our chart, it's like, we want to buy with the strength, buy with momentum, buy with the trend. That's where you put the odds in your favor of getting a good result. People who look for bargains, so you just look to the other side of this Doug Technology chart. When the market's falling, like, people who are trying to buy a bargain, get a stock after it's come back 10% or 20%. Once the stock is below these moving averages, the path of least resistance is down. Sure, it's going to bottom at some point, probably. And some stocks don't bottom, some stocks go out of business, but a lot of stocks, they will at some point bottom, but we don't know where that's going to be or when that's going to be. It could be years before a stock hits a bottom and then turns higher. So it's investing with the trend, not against it, not when the market's coming back. Rule number 3, it's let those profits run. Just going back to Calix, it's like, what if you sold this stock for a quick 100% gain or 50% gain? What if you took 200% off the table? It's all a great result, but the big money's made when you let something run, because you never know how far they're going to do. And to do that, you've got to risk the temptation to take those smaller profits. And it's the temptation to take a a 30% or a 40% gain, which makes it so hard for people to do well on the market, because great, we've got a 30% gain, but that probably just balances out a 20 or 30% loss you might have. And if you're like a lot of people, you take your 30% gain, but you don't cut your losing trades, and you end up with a 60% loss. So your moderate wins aren't covering your large losses. The whole thing's back to front and upside down. It just doesn't work. And that brings us to the fourth rule, and that's cutting losses. This is just so important. You've got to cut those stocks when they go into backwards. So another interesting example is a stock called Appen. So this was a great stock. This was a great stock during the 2017, 18, 19, even into 2020. There was it was a stock you wanted to run with. You wanted to buy into this trend. And a lot of people then see these long trends and think, okay, this is just the way this stock goes. When it pulls back, I want to buy it. And that can work at stages, can work. Sometimes you buy these dips. If you bought the dip in March 2020, turns out it was a good dip to buy, despite being below the moving averages. If you insist on doing that, it worked out. But often doesn't work out. You look at Appen a little bit later on. If you're buying the dip after it turns for a larger downward sequence, it really becomes an issue. So had you bought Appen into strength, the market starts to roll over, it's not doing what you thought it could do. It's often best just to cut the loss. Say it didn't work, I'm out. But a lot of people then will persist and say, look, it's going to bounce back. What if I give it a bit more time? Maybe I buy a bit more, I average down. But the problem is, what if it doesn't bounce back? The problem, Roger, isn't when you buy a stock and it bounces back. The problem is when you buy a stock and it doesn't bounce back. And look what Appen's done. And this was a market favorite stock. A lot of people love this stock. And look where it ends up. It's down here at below $1 now, from highs up at $40. It's been an absolute disaster. And you'll hear people say, well, look, they'll get stuck in a stock and they'll be down 60, they'll be down 70%. Stock's trading at $10. It wasn't bought at 40, it's now at 10. They say, oh, it's too late to sell. But it's never too late to sell, really, because look, it goes from $10 to $1. So it's down another 90%. So cutting loss is really important. And then the probably the hardest rule of all is giving your trades room to move. I'll show you another great example. Stock called Matter Group. So this was a recent exit from the Motion Trader portfolio, and but it was a great trend. It was a great trend over a couple of years. It's recently just come back and triggered that exit stop, and people often look at this and go, yeah, look, that was again a pretty straightforward trend. But you've got to look at these pullbacks. It's like these pullbacks, when you look at them a little bit closer up, they're pretty severe pullbacks, and a lot of people don't want to sit through that. So just measuring this pullback here in 21, that's a 32% decline. So it's interesting. So if you want to get in this case, this was let's see, it ended up being a 500% win. To get that 500% win, you had to sit through several 30% declines. So this is also something which is really important to take on board, because people often tell me they like to run close trailing stops. They don't want to give back too much profit if a stock starts to pull back. But if you're not prepared to sit through like a 20 or 30% pullback, it's probably going to be pretty hard to get a 500% gain. And so this is one of those things which I think catches a lot of people out. And I think this is the hardest rule at all to grasp. I'll quickly put on an ATR trailing stop. We talked about these last week. So this isn't exactly the same as the Motion Trader one, but it works. It's a pretty good replication. So I'm going to set this. It's interesting. A lot of people like to work with the close ATR stop. So an average trading range is effectively what an ATR stop is. So it's giving, in this case, we're using, it's got 3, that's the default setting. So the trailing stop is set. Let me just expand this a bit. Let me just move this a little bit. So you can see the stop below the share price. See how it hugs the share price? So it's a multiple of 3 times the average trading range of this stock over the previous couple of weeks. That's how it's set up. But that's a really tight trailing stop. That's how a lot of people like to do it. And you can see you can't stay with it. Now I'll show you what I use with I use myself. I use with Motion Trader. I use a multiple of 10. It's 10 times that average trading range. And when you do that, you can see you can stay with these. You can stay with these big trends. We can pull this back a little bit further. Where's it gone? Yeah. So basically stays with the whole way up. Sees off these double-digit corrections, which are several of them, and the Motion Trader stop has triggered. So it's a little bit different. But this is the thing. Give them room to move, and then this whole thing becomes the mechanical way of thinking. And if you can adopt this sort of rules-based process, then I think, Roger, you really open up that potential for making plenty of money from these big trends when they do get off and run.
Yeah, of course. All right. Let's just have a quick. I'm just have a quick look at some of the comments here. Obviously, could you please talk what averages you are using? You're using 50 and 100. Is that right? 50 and 100 is the ones
exponential. The 50 and 100 day exponential moving averages.
Exponential moving averages. Got some golden rules from people. Control your risk. Yes, exactly. I think that goes with rule number 1, spread your risk and then control it at the same time. Exactly.
And then it also comes in and combines with cutting your losses and having the trailing stop. So it comes in on several levels throughout those rules.
Yeah. And then we've got Robert saying, follow the big boys. Simple. If you've got some big, you follow Jason. He's a big boy as well. So you could follow some of those ones.
Well, it's an interesting thing because the big boys aren't going to be in Doug Technology in a large way because it started off as a $100 million company. So the big boys can't really move in and out of that. And this is the advantage of the retail trader is that they're using smaller amounts of capital, so they can get in and out of stocks which are on the fringes of the all ordinaries. So it could be a stock. I think when I bought Kalex, I don't think Kalex was even in the all ordinaries. I think it fell just outside the top 500. So the big boys, they weren't piling in because they can't move a sizable amount of capital into a smaller stock. And we're not talking about $5 million speculative miners either. We're talking about sizable businesses, but there's still not enough scale for the big boys. So the big boys are going to be concentrating in the ASX 200, probably more specifically the ASX 50. But you're probably not going to get CBA going up 500% in the next couple of years. Anything can happen, but it's probably not. You get those big gains at the mid end of the market. Not to say don't look at the big stocks. There's great potential in many of them. They pay good dividends. It's not saying something's better than another. It's just saying that as a retail investor, there are options available which aren't as exercisable for some of the big players.
Yeah, that's good tip. LYL, did we look at that? Did you look at that as a chart? Can we look at LYL?
LYL. So that was a Motion Trader stock which hit its exit this week. Let me just call that up.
Marcus said, let's have a look at LYL quickly.
And I had this one myself. I sold my shares last week. So look, the situation with this now is, so I'm just going to get rid of that trailing stop for now. So look, the entry point, we can see with the moving averages cross, we've had.
Do you want to share your screen? Share there.
These screens, goodness me. Yeah. There we go. I
think I could have done that actually. Yeah.
Flicking between too many screens. Okay, yeah, look, you can see we've got the moving averages cross. We went into a good upward phase. Really strong acceleration in April, but then since then it's lost its momentum. It's pulled back to the moving averages, which was fine. There's no problem with that. I'm happy to sit with the stock as it pulls back towards those averages, because often, as we saw back in November, December, a pull back to the averages with some consolidation was in another launching pad for another rally. Hasn't happened on this occasion, and this will happen too, where the market comes back to the averages, stalls, starts to fall beneath them. Moving averages have now crossed to the downside. So I'm out. So I sold last week when it hit my trailing stop. It's the motion trader's trailing stop, and just cut the position. Took a good profit. Wasn't a mega profit. Most of them aren't, but it was a good profit. Now, this is a thing. Like, what do you do? Like, if you don't sell on a trailing stop like I'm using, what are we doing at this point? Do we have some sort of a fundamental view that we think, look, this is a great stock and it's going to do good things over the next 5 to 10 years? A lot of people said that about Appen. I'm not suggesting this is going the way of Appen, but that's one of the things that can happen. Is this it? Is the selling over? And this happens as well. We'll have stocks come back, they trigger the exit stop, and then they base and they start going back up, go on to new highs. That could happen too. What worries me, it's not the stocks that hit a trailing stop and rebound. They're not the ones that cause the trouble. It's the ones that go the way of Appen, where they can just continue to spiral lower over many months or longer. So we don't know. Will the final low be somewhere around here? It could be, but we don't know. And that's the uncertainty that we're trying to manage. That's the risk we're trying to manage. And to avoid getting caught in a stock like Appen, it means you've probably got to consider cutting a stock like LYL at once it's below these averages and it breaks down again. It could bounce back, but I always say, what if it doesn't? That's what we're managing. We're managing the what if it doesn't bounce back risk. I think that's always the key thing with these situations.
Yeah, and I think once again, me being I'm quite optimistic but you've got to be sometimes more fearful of the stock that loses you 95% of your capital versus the stock that might gain 95% of your capital. It's not to come from a fearful point of view, but many times in trend following, it's going to go down versus. I mean, I don't know what if you know your win-loss ratio, Jason, but would you say there's generally, well, especially in this market conditions, there's probably going to be more losses than winners, right? So,
as a general proposition, trend following strategies typically bat below 50%.
Yeah, exactly.
40% might be sort of like give or take on that. And a lot of people here, they can go, well, that's not a very good strategy. Because there's so much marketing, which I see, so much nonsense, where the spotlight's put on the win rate. It's like trading isn't like being a pilot, where if you don't have 100% win rate, you're out of the game. Trading's very different. It's about how much you make when you're right versus how much you lose when you're wrong. And when you're playing along that sort of line, you can be wrong 60% of the time. But when you're wrong, you're not very wrong because you cut your loss. But when you're right, you're very right. And you might get a few stocks like Calyx, which go up 500%. You have plenty in between, which go up, 20%, 10%, 50%, 100, 200%. And then you get a few outliers, which run a really long way. So it's about being a little bit wrong, probably most of the time, and very right some of the time. And that worked really well. And it was really interesting what you said about being fearful when a stock is falling. I think that's exactly what you've got to be. When a stock is in reverse, you've got to be fearful. You've got to be fearful that you're holding onto an Appen, a stock which is going to go from $40 to $1. That's what you've got to be fearful of. And when a stock's rising, you've got to be hopeful. When you're holding Calyx, you've got to be hopeful that it's going to go from $2 to $3 and from $3 to $6. You've got to be hopeful of that. But so many people get hope and fear the wrong way around. They're in Calyx. They get fearful when they're up 50% and they cash out because they think they're going to get back their 50% gain. And when they're in Appen, they're in Appen at $35, and they hope it goes back so they can get out at even. So it's upside down. It's all back to front, topsy-turvy. So I think for a lot of people to do well in markets, they've got to completely shift the way they think. And this is where trend following can really help, because it can give you that disciplined process where you buy into strength, you let profits run, you spread your risk, you cut your losses when the market doesn't run, and you give it room to move. It's 5 very simple principles, but you've got to apply them all to make the whole thing work. Often people miss 1 or 2 steps, and often it's giving stuff room to move. That's a big one people miss and mess up all the time.
Yep, it's exactly right, Jason. It's good, always good advice, good tips. So how do you continue having faith in these current market conditions, Jace? How do we continue having faith right now?
Yeah, it's really interesting, because it's so we've been 2 years now without a new high in the All Ordinaries or ASX 200, and it's a tough period. It is a tough period for most people, for the vast majority of people, to make money. Look, I don't know too many people who are making really good headway or making much headway at all in this market. It's just how it goes. So people will come and look at a trend following strategy like what I do with Motion Trader and go, well, look, you're not making much money. And the big point to make is that trend following strategies do their best work when there are trends in the market. When the market's going sideways to lower, you don't have uptrends. And that's one of the phases. So the market moves in phases, up, down, and sideways. It's about, in the sideways and down, it's about minimizing losses, protecting capital, both financial and emotional. So when the trends invariably turn, whether it be in 6 months, 1 year, 2 years, whenever it may be, when the trends eventually turn and resume to the upside, you're ready to play. And that's when you do get a lot more stocks with breakouts that run a long way. And that's where you make money. But there's so much evidence to like look at trend following over time, like looking at high profile trend followers, looking at trend following funds, looking at back testing, which I want to show you in a moment, and just my own experience, that we know that these things move in cycles, and it's not a one-way street. Otherwise, it'd be really easy. Everyone would just say, okay, we just follow trends. It's easy. But it's not, because you've got to go through the periods where there are no trends, when a lot of people drop out, and then the trends resume after they've been running for a while. Everyone gets excited, and they stop working for a while. It's just how markets move in cycles, not just trend following, value investing, growth investing, whatever it may be. There's cycles with everything. So back testing is a really interesting concept. It's a really interesting analytical approach, where what we do, so you can get a set. You come up with a set of rules. Say you want to test something. Say you want to test. Say you think, look, every time a stock gets above the 50-day moving average, I want to buy. Every time it falls below, I want to sell. Just say you want to test something. So rather than like using real money or trial and error over a couple of years, what you do, you get a whole lot of data, and you program your rules in. You've got to get some sort of a software package where you can program your rules in, and you test it. You actually see, how did this work using past data, and that gives me an indication of how it might work when I roll this forward. When I backtest, I use lots of data. So I use, I've got like 30 odd years worth of data. So I want to see lots of cycles. And I'll show you. So what I did yesterday, I ran a test on the Motion Trader rules that I'm using with the Motion Trader service. I set up a $200,000 portfolio going back to 1994. 0.5% of capital in each trade, so it allowed for a 200 stock portfolio. And I'll show you what happened. Hopefully I get the right screen this time. And is that the one I want to show you first? No, I'll show you this one here first. It's and this is what the back test looks like. This is 30 years of using a trend following strategy. It's simple strategy. We're using the 50 and the 100-day moving average, 70-day breakout high, that 10 ATR trailing stop I told you about, spreading the risks as I told you. There's not really a lot of complexity to it, but it's bringing it all together. And this is this is what happens. You get this rising equity curve. Now, this is a linear scale, and it's actually a bit hard to see what's going on in the first 10 years due to the extent of the gain. So I'm going to switch over and look at a log scale. And now you can see this back end a bit differently. And this is where so you're asking, Roger, how do I get confidence when you go through a rough patch that it all still works? And you get confidence. Well, I get confidence because I can look back and I can see that what we're experiencing now is not unique. There's been other periods which have been just like it. So this is the drawdown. You can see down here. This is showing the drawdown from a peak. So when you get a peak in equity and you start getting a pullback, it's what's called a drawdown. So the drawdown currently is on this back test is a bit over 20%, and we can see during COVID it got down towards getting down towards 30%. Over in the GFC period, it got down a bit further still. During 1994, there was another period which is a little bit deeper than this. This was interesting because this was also during a bond collapse, like we're seeing collapse in bond prices and bond yields going up. This was a similar period in 1994. And just when it's at its darkest and things are looking the gloomiest, the market started to rally again. But you can't be sure. You can't know when. But you can see that there have been periods, and this GFC period was interesting because from the previous equity peak, it took several years before there was another equity peak. Doesn't mean that you couldn't make money for several years, because once the market bottomed about a year and a half after the peak, then the gains started to come back in. It just took time to break the previous high. How this current situation plays out, time will tell. Time will tell whether the drawdown gets deeper, how long it's going to be before we get back up and make a new high. Is it going to be like the GFC period? Will it be shorter? Will it be longer? We don't know. But that's where you get the confidence. You do the back testing. And another interesting point with this, there are 2,002 trades in this simulation. So it's not a case of one super stock just taking off over the last 30 years and doing something remarkable. It's 2,002 individual trades over 30 years, so about 70 trades per year. So this is where you can see, and this is what you want in a good back test: a lot of time, a lot of trades, and then you know whether your approach is repeatable. I think this is a key point. To anyone trying to come up with an investment process, you've got to say, is it repeatable? Will it work over and over again? And I don't mean every single time, but in general, is it a repeatable process? And that's what back testing can help you do. And this is what gives me, that faith and confidence, because I've seen it work over and over again over many years through back test and real life experience. And so that's what that's how for me I let these things roll.
Yeah, no, it's a great graph. It's in terms of showing, obviously, backtesting requires more advanced software for people. So if you look at that and you just have faith, but if you think of the stock market as a whole, like it's something that's never, it's always recovered and kept on going up, right? I think it's one of those things where you've just in this current conditions, well, we're not even that bad at the moment compared to what happened in COVID, and look what happened straight after the sort of COVID hype ended. It just boomed up even stronger, right? So and understanding that's just a trend on the way up, right? Sometimes what comes down must come up, or what comes up must come down, right? So it's good to see all that proof on the graph that you just brought up, with that back testing. And the thing is, what we've got on,
there's stacks of it. There's stacks of information out there about how markets do move in large trends, but they don't move in trends all the time. A lot of the time is spent in sideways periods and also in downwards periods. Upward trends are only one part of it. And so it's just about, the old saying, you make hay when the sun shines. That's what trend following is all about. It's about waiting for the right conditions. When the right conditions are there, you let your profits run, you maximize your gains. And when the conditions aren't there, you reduce your risk, you pull back, you take less trades because you're getting less signals, and you wait it out. You wait out the period, and whilst you're waiting it out, you're probably taking some small losses along the way because you're getting false breakouts which aren't running. But then at some point, if all the recorded history of stock markets that we have continues to play out, markets bottom, and then they start to go on another multi-year advance. But you've got to be able to stay in the game, and you stay in the game by having the confidence that processes work over time.
And it's an important thing to note that markets go up and down, not individual stocks. Some individual stocks go down and stay down or delist and gone, right? So that's why it's really important to understand you've got a diverse range of stocks that you're investing in that back test. And it's not, like you said, to your point, it's not just, one or two winners that have made that massive equity curve go up, right? There's a lot of stocks doing that work there for you.
Yeah, 2,000 trades. Of those 2,000 trades, like I think I saw when I did this yesterday, it was around 45% were wins, and the rest losses. And
It's good.
It's that's trend following. That's how it works. But as we talked about, keep the losses relatively small, and then those winners, you leave them open ended to be everything they can potentially be, and you resist that urge to bank little profits along the way.
And have the faith to sit through 70% of losses, right? So to ensure to think that your 30% of that is gonna make up for all those losses, right? So there's obviously, we've got a comment here. And the truth is that, yes, there is a difference sometimes when you look at a chart from a technical point of view versus the fundamental point of view. And that is, what the management team is, what the books look like, what the income statement, there's always going to be a difference there, right? So if you're into investing, value investing, or, buying low and selling high, then your strategy might not be a technical one, right? Your strategy is more of a, like I said, value investing, right? So what we're talking about here is just being super clear on, how to enter and what to enter and how you're going to exit more than anything else, right? Because, like I was just saying to my point before, markets will generally always go up because that's how capitalism works in my eyes. That's what I've heard. That's what I've been told. Markets will always generally go up. All right. Otherwise, it's just that's just how it works, right? But companies individually will not always go up. They will, when they go down, they'll go down and may stay down, and you may never see it go up ever again. But that's not to say it doesn't go up as well, right? So, but it's just how you enter. Yes, if you've entered from your trade as a value investment proposition, then that's fine. Stick with it until you're comfortable with that company doing what it's doing. All right. But if you're entering from a technical point of view, and to your point, Jason, we've got to have a repeatable system that we can go in and out on a daily basis, right? So,
or you combine. You can also combine the two. You use momentum to identify potential opportunities. Run the numbers over them, see what the story is. But also be aware, even if you're a value player, once a stock's below the, say, 100-day moving average, question it.
Just start looking at the books again. Start looking at all the.
Really interesting. I did a video a few years ago where I talked about how Appen had hit a trailing stop for motion trade, and this was before the big $40 peak. This was earlier on. It might have hit a trailing stop at, say, $20, for instance. And somebody wrote in and said, "Yeah, you did well. You got 100%, but I'm not selling. I'm in for the long term. I'm in for the next 10 years because this stock is going to be amazing." And I wonder what happened. I wonder whether he wrote it through to 40, and I wonder whether he's wrote it down to 1. It's all well and good to think that you know more than maybe what the market knows, but sometimes standing in front of the market saying the market is valuing this incorrectly, it can be dangerous. It can be dangerous to your portfolio's value. It can be dangerous to your wealth. It's arguing with the market. You often come off second best. I think it's just something people need to be careful with if they're diehard value investors. But diehard value investors probably aren't watching today. So and I'm not here to convince anyone of anything. It's just understanding some basic principles of, if something's not working, you've got to consider, what do? Do I just hold it forevermore because I think I'm right, or do I is where ego gets in the way as well with a lot of people. It's the belief that they need to be right can really short circuit a lot of people's portfolios, and they find it hard to take losses because they don't want to be wrong. Frankly, I don't care whether I'm wrong or not. It's about what the portfolio's balance is. That's all that matters. There's no ego involved. It's look at the price action and run with the price action. If the price action doesn't agree, well, you probably get, for me, it's probably time to change my view.
Yeah, certainly don't care if you're right or wrong. You become very robotic at things, and that's yeah, that sort of helps you sometimes with your emotion, right? Managing your emotions. I think not caring whether you're right or wrong, and just knowing that the system works, right? So, lithium energy. Let's just look at one more stock. I think, Jace, with our time that we've got here, lithium energy.
Okay, and what's the code for that?
Can you type it in? Can you type it in, maybe? Just type the full thing. Is there something come up? Oh, there we go. Yep. That's the one.
Yeah, it's typical, I think, of a few lithium plays at the moment. They've had a good recent run. Look, different ways you could be playing this. Like if you're looking at probably a 20 or 30-day moving average, you probably find those moving averages might be crossing now. For me, it's the 100 and the 200. Oh, sorry, the 50 and the 100 haven't crossed. They're going to take a while to turn themselves around. So I'm not playing this one. I'm just looking for any other structures of note on the chart. There's nothing really that stands out. It's for me it's a no. But just out of interest, let's have a look. If we're looking at it, say a 20 and a 30-day average, does that start to cross? Yeah, and it has. So if I was shorter term, 20 and 30 days, that can be good shorter term averages to look at. I'd probably still be thinking, look, it's had a good run above the averages, and maybe it needs to do some sort of consolidation, let the averages start to catch up, and maybe there could be something there. Of course, you've got to manage the risk with it. Yeah, interesting to keep an eye on, but not quite for me.
Okay. And one last one. I think we've gone through this one before, actually, but RMD, I think we've done this a few times. I don't think it's looking too healthy at the moment.
It's had that shallow bounce, that classic shallow bounce back towards the moving averages. So you've got the big decline, the shallow bounce, hasn't quite got back to the averages, but the averages have caught up a bit, and it path of least resistance is down. It looks like it will go lower. At some point, it's quite possible it has a decent bounce, and some people would probably try and trade that bounce. Like it could rally back. Like, you know, you put some Fibonacci's on it, and like we don't know where the low point is. But even if it's just for argument's sake, say it was we had an interim low in place, you could get a bounce back towards 27 or something. But there's no uptrend there, so it's not something I want to play.
Yeah.
It's a sort of stock which is just it's not even on my radar. It's on an avoid list, which I'm not even looking at. It's a stock which, if I had it, I would have been cutting the loss as it was falling and looking elsewhere. I think there are simpler ways to make money than trying picking lows in stocks which have had sharp falls. And yeah, they could rebound, but it's too hard. It's too hard to play. I think to play those situations.
Okay. All right. I think we will wrap it up here, Jason. Don't forget, everyone, whether when we say we're in or out of a stock, this is all general in nature and there's no personal advice given here. Obviously, do your own research. Next week we're going to be out for 1 week, so giving us a prior warning. It's the Melbourne Cup, obviously, so there's a public holiday here in Victoria, but we will be back the week after, and we're going to be talking a little bit more around some of the tools that we mentioned that we haven't really covered. So maybe things like the break and the retest, we're going to get today, but I think we're going to run out of time. So break and retest sort of entry strategy, which is something that I really like. And we might just go on that, talk about that Fibonacci's and how you use those as well, Jason, because we haven't really spoken about those. They're quite good. So we'll be back on the, what date? The Tuesday, 2 weeks from now, which is the 14th of the 11th. If you do have any stocks that you want us to analyze, on the show, then you can always send in an email at support@selfwealth.com.au and just attention it to Roger or Jason, and we can see that. I'll see those emails coming in hopefully by the time the show airs, and we'll jump on that. If you have any questions, certainly send them through as well. Jason, thank you very much for today. Much appreciated once again.
Yeah, it's been fun, Roger. Really enjoyed talking about the trend following strategies and that. And definitely send some codes in. Let us know. Let us know what you're looking at. It's always interesting to have a look at these stocks and look at them from a trend perspective. And you never know what opportunities we can identify.
We can identify exactly. Thank you everyone for rocking up. I get pumped for these sessions. Actually, it's what I look forward to on Tuesday. So I'm glad there's still people here looking at us and watching us. I'm very happy for that. Please like and subscribe and comment if you want. Hopefully we'll see you in a couple of weeks' time. Thank you very much, everyone. Take care. See you, Jace.
See you, Roger.